These are the 4 things that I believe you have to master to become a profitable ICT trader. Now let's get into them. Let's have a chat and then we'll go into the markets to see some examples of how you can apply this in all sessions, right? The London session, also the New York session. So firstly, fair value gaps. That's probably one of the most important things because the market is only driven by 2 factors. The first is driven by the fact that it wants to target imbalances, and the second is the fact that it wants to target liquidity. So what do I mean by fair value gaps? I mean imbalances in the market, bullish gaps, bearish gaps, but what time frames, Ruben? What time frames are you looking for? For me personally, 90% of cases, like I've mentioned in previous videos, are the 15-minute time frame. The second point I want to talk about is liquidity. Now, there's different forms of liquidity, right? There's different forms of liquidity. There's low resistance liquidity, there's high resistance liquidity, and for me, I like to target the first form, which is the low resistance liquidity. We'll get into some examples. The ranges, I'm talking about where are we sitting in the range, right? If we mark out, Asian range, or we mark out London range, where are we in that range? Are we at the top? Are we at the bottom? Are we in the middle? Because that's going to change how you trade, if you're trading towards liquidity or if you're waiting for liquidity to be swept before then taking a trade. And the last thing is time, right? A lot of my strategy is based on macros, but also based on key kill zones, for example, silver bullet timeframes. So you've got to match all these concepts of price, 1, 2, and 3, with the concept of time. So firstly, I just want to touch base on what is liquidity and why are different types of liquidity better than others. Now, there's 2 differences, right? Look at the price action doing this, number 1, as opposed to price action doing this. Now, would you agree that we are still stepping up in price, but one looks a little bit different to the other? A little bit more cleaner than the other. But what I'm trying to get at here is, on this left-hand side, each of these swing highs have been swept, right? Each of these swing lows haven't been swept. On the right-hand side, the swing highs have been swept, but some of these swing lows have also been swept as well. So this case, in my opinion, is better than this case. And the same applies for a downwards trend, right? A downwards trend. If the market, is moving down like this, it's making lower highs and lower lows. I want to see these highs left. I want to see the main highs left or exposed because that forms low resistance liquidity. It's different to, price action doing something like this. Price could step down, but then do this, and then step down and then do this. If price is doing that, to me, I just see that as price sweeping sell side liquidity so it can move further down and move further down. So that there is low resistance, that there is high resistance. And when you're targeting trades or you're targeting liquidity, you want to target low resistance liquidity rather than high resistance because the move is going to be a lot quicker than the opposing liquidity type. That's really, really important to keep in mind. All right, so now let's talk about ranges in the market, right? You've probably heard ICT mention a few different points. One of those obviously is equilibrium, which is really important. So equilibrium. Another one is maybe optimal trade entry. And he talks about the concepts, premium and discount. These are things that are really important to master. Why? Because the market moves from a level of premium, discount, premium, discount, premium, discount. And I'll show you an example of the charts here. This is from yesterday's price action in the London session. But there's different ways you can do this, right? Now, what I want you guys to do is I want you to have a look at this swing low I'm going to mark out. So I'll mark that out in red. And then let's mark out now a swing high in a different color. So I'll do this in green, right here. So notice how what I've marked out, this here now is technically the low of the range and the high of the range. But would you also agree that on a slightly higher time frame, so the 15-minute time frame, if we look at exactly that same zone, and we go across here, notice how in that range, if I was to get rid of this, in that range, you also have a smaller range, right? So you also have this swing low here. The swing high still remains, but notice how there's now 2 swing lows to keep in mind. So each of these points you can draw a Fibonacci from, and you can then base a trade off, right? So you're looking for price to react from key zones. You're not just taking a trade anywhere during a macro time frame. You're waiting for price to react from these key zones. And realistically, there's 2 ways to do it, right? Say you're trading, the London Open session, for example, and you see price, at this point. You obviously want to see price firstly respect this 15-minute imbalance. But as soon as price does this, right, let me just go back here. When a price does this, what are you looking for now? You're looking for a reaction from the optimal trade entry zone. So I would mark out my Fibonacci from this low to this high and see how we react in this zone. Now notice, look at this, notice how price reacts from that zone. And we're using just the 15-minute time frame here to get like a bigger perspective on the price action. We react from that OTE zone, we push price back up. Where does price push back into? This imbalance. After tapping into that imbalance, where do we react to again? Back to the downside. Then you might say, well, can I take a trade long here? Of course, right? That there can phrase a high probability trade. Say you go back to like the 1 minute time frame, you can probably find an entry here using an inversion fair value gap to push price higher. So notice how you can merge like the 15-minute time frame and the 1 minute time frame and these concepts of optimal trade entry and ranges to phrase those high probability trades and know in essence where the market might retrace from and where it might react from, right? It's one of those really important things where once you react from the OTE zone, you can't demand the market go all the way up here. Of course, that'd be great, but you just got to wait for price to see how it reacts from any imbalance. Any imbalance, this one or this one, is a chance for the market to retrace or reverse. It's really, really important to keep in mind. If you're writing notes, any imbalance is an opportunity for the market to retrace or reverse. Really, really important. So again, we react from that 15-minute imbalance, we push down. Where would be the next point of reaction that I might see the market moving from? Maybe after sweeping this level of sell side. Now, why that level of sell side? Why not something here? Well, we talked about this smaller range and then also that larger range. This larger range, again, get your Fibonacci from this low to this high, draw that across. Where have we tapped back into? OTE. What also rests in OTE? Sell to liquidity. What also rests there? An imbalance, right? All these imbalances, right? All these imbalances offer opportunities for reversal. When you can get these imbalances in a level of premium and discount, it makes these trades higher probability, right? So this is one of the concepts that you have to master as an ICT trader, in my opinion, to be profitable. You have to, because this gives you an idea of where the market could reverse or retrace from. And just even getting this big range, guys, if I was to draw a box from this low to this high, let's say I draw a box like that, and then I use my Fibonacci to measure out, the halfway point. So I'll draw that box, I'll use my Fibonacci. You can use a game box too. But let's say I do this, right? And then above, maybe I'll make that a little bit of a different color. Like you see people doing this, maybe they make that a green color, right? And then below, maybe I'll make that a red color. This is a concept of discount and premium, right? That there is the dealing range, in my opinion, that I'm using. It's the previous price swing up. So anytime price is above 0.5, it's a good opportunity to short. So if you see an opportunity here to go short, you can go for a short. Anytime we're below this equilibrium point, if you see an opportunity to go long, you can go long. Now, sometimes the market is just going to disrespect these points, but a lot of the time it won't. And more often than not, right, price is going to react from discount or premium. So you can see price comes up, comes down. We haven't reached equilibrium yet. Pulls back up, shorts. Pulls back down, longs, right? Discount, premium. So premium back in a discount, and then let's see what price action does. Back into premium. Now, could you go for a short again from here? Of course, but you're seeing what price action does as per a time basis. So you're looking for those macros. You're looking, for silver bullet time frames. So if I was to mark out the silver bullet, for example, let's mark out 3 to 4, right? That's 3 o'clock with this line here. Let me make that a little bit thicker. And then where's 4 o'clock? 4 o'clock is right here. Between these two dotted lines, can you guys see that there is an opportunity during silver bullet to go short? Price is in a level of premium. We return to a 15-minute imbalance. It gives you an opportunity to go short. Where can you take the short to? Well, there's many places. You can hold all the way back down below equilibrium, or you can just take it to the next level of sell side. Alright guys, so now let's go for an example for the New York AM session. Let's have a look at how price reacts, and let's draw the same thing out. So again, what you can see here, guys, if I was to mark out this with a highlighter, we've got a swing low here, and we've got a swing high here, right? So that there could be classed as a range, right? That could be classed as a range. Now you could draw the same thing up with a box, and you could, measure equilibrium, which is fine. So say we did that now, we did the Fibonacci from this low to this high, we mark out equilibrium, and we draw that box up, right? this will completely change your trading. So down here, obviously, we've got the red zone, and this is obviously going to be our level of discount. At the top here is the green zone. This would be our level of premium, right? So premium, discount, premium, and discount. Now, we're looking for places where the price can react in these different zones, right? That's what we're looking for. So if you're trading the New York session, for example, that's your low of interest, that's your high of interest that you put in. Price comes back down into a level of discount, right? That's a longing opportunity if you see an opportunity to go long. But if you don't take the position, right? This here now is an opportunity to go short. We come back up into a level of premium. We tap just into, right, this 15-minute SIBI. Just, right, by the tick. If you can phrase a trade in that price point, that gives you an opportunity to go short, right? So notice how when you've created a range, you can mark out equilibrium discount, premium discount, and you can phrase as high probability trades. If you are not in a level of discount, you don't go for longs. If you're not in a level of premium, you don't go for shorts. Now, will this always work? No, but it works more than not, and it saves you from taking, those silly trades where, you're looking to long, for example, all the way up here. You're looking to long all the way up here, and you wonder why it doesn't work because you haven't really retraced enough to have a pullback. I think it's really, really important to keep in mind. So you go from, discount to premium, and this is an example here for the New York session. So having a look at price action, if we just go back to this time frame, let's have a look. We've obviously returned back into a level of premium here. Let's go to the 1 minute time frame to see what happens. Now, notice here, look at this. This here is also a macro, 950 to 1010. 950 to 1010. So if you could phrase a trade to go long here, you could take a small long position there. That's completely permissible. Or you can wait until the next macro. Where's the next macro? 1050 to 1110. We sweep some sell side liquidity, right? We sweep some sell side. We create this inversion fair value gap here. And you could go for a long position like that. Stop below the low, right? Or below the inversion fair value gap candle. And you can target what you need to in terms of risk to reward. So notice how price, when you adopt these concepts, when you go back down to a smaller time frame, it makes it much easier to understand where the price could actually react from and retrace from. Because if you don't have that 15-minute concept or time frame, in your mind, you could be looking for longs and shorts in conditions that are not as probable to take the position in, right? So that's a really, really important concept that I think a lot of people need to understand and to practice marking out the dealing ranges, to practice marking out equilibrium discount, because realistically, it's all you need. All you need, in my opinion, time, right? If we were to summarize this, all you need, in my opinion, is time. So you need macros / silver bullet timeframes. Number 2, you need fair value gaps because that's where price can react from. Number 3, you need liquidity, like low resistance versus high resistance liquidity. We talked about that. And number 4, you need the ranges. You need ranges. So I hope you guys got something from this video. Until next time, I'll talk to you guys then. Peace.